Hello, and welcome to Portfolio Matters Share Talk. In today's episode, we will be concluding our reviews of UK listed mining royalty companies by looking at Trident Royalties. But before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Okay, so we have now covered three other mining royalty companies. We liked Anglo Pacific, which is the biggest one. We were positive about Altus, though we thought the shares had come a long way very quickly and were worried about the valuation. And those worries appear to have been justified, as the shares are down about 20% since we did our share talk. And the last one we covered was Metal Tiger, where we thought the costs were too high for the asset base. And this one is Trident Royalties, which is a relatively new company. It was listed in 2018, October 2018, when it raised 4.4 million. And since then, it has done a number of share placings, and its market cap is now around 60 million. Okay, so its current share price, actually, it's drifted up a bit since I did this. So it's probably about 37p now. Market cap 60 million. According to Stuckipedia, it has net cash, but a lot of that cash is committed. The reason we are looking at mining royalty companies is that historically they've done incredibly well. Richard first looked at Ely Gold Royalties, and when he did that presentation, that was the first time I'd ever heard of mining royalty companies, and he included some charts which showed absolutely extraordinary returns for Franco-Nevada. However, in doing this presentation, the main takeaway for me was how much more competitive the industry had now become. And mines now have a large number of sources of capital and of mining royalties, and private equity has become involved. And the deals that Trident have been picking up, the vast majority of them have been in the secondary market. So they haven't been dealing directly with the mines. And so there's then a selection bias. I mean, why are Orion Mine Resources, where Trident have got some of their deals from, including the big Thakur Lithium royalty, I mean, why are they selling those? You know, there's a selection bias. You think that actually the only ones they'll be passing on to Trident are the ones they don't really want. And also there's a middleman cost. I mean, it would be much better for Trident to be trying to deal directly with the mines. But part of the investment case, therefore, must be that you believe that as Trident grow in scale, they will get better access to primary deals without having to take the leavings of Orion Mine Resources and others. And obviously, the company is very difficult to value at this stage because a lot of the royalties in the future, all these deals have been signed with quite early stage mine developments, but they have done some good deals. The Kulia or iron ore mine deal looks absolutely extraordinary, but it's small. I mean, that deal was done when the company had a market cap of 10 million. And now when the market cap is 60 million, it doesn't make that big a contribution. You need some big deals coming through now. And a lot of the deals we are going to go through are actually quite small. And as Trident grows, it's going to have to do bigger and bigger deals to change the cash flow and the revenue. So overall, I think Trident could be a decent investment if you believe that the company will grow and get better access to deal flow. But right now, I think it's probably fairly valued. It's certainly not a bargain. And my key takeaway from doing this analysis was I worry that I am anchoring on the extraordinary returns gained by the mining royalty companies like Franco-Nevada 20 or 30 years ago. And actually, the market has since become a lot more competitive, and the deals that are being done now are fundamentally a lot less lucrative than those ones which created the extraordinary revenues that Franco-Nevada, for example, are currently enjoying. Okay, so this is a chart from Richard's presentation on Ely Gold Royalties, which I recommend everyone dig out. And it shows the performance of Franco-Nevada and Royal Gold and the other gold royalty companies in their early years. But you'll see they are all quite a long time ago. So here, in the case of Royal Gold, I mean, it had absolutely extraordinary early performance. But we're talking in the early to mid 90s. And Franco-Nevada, we're talking in the mid to late 2000s. And Ely Gold, that is much more recent, actually. But that has benefited from an extraordinary rise in the gold price over that period. This is the share price of Trident Royalty. And as you can see, as it's done share placings, the amount of available shares has massively increased. And so the liquidity has increased. And so it has become more volatile because people can actually trade the shares. Okay, so let's go through key events. So IPO was in 1st October 2018, so really not very long ago, 2.5 years ago. And they raised 4 million at 20p, market cap 4.4 million. Then in March 2020, they did a great deal. So they managed to buy this royalty, 1.5% free on board royalty over an Australian iron ore mine. This was at the bottom of the commodity cycle from a seller whose main business was not in royalties, and they bought it for 4.4 million sterling. And in Q2 2020, it kicked off 500 grand sterling, so 2 million analyzed. So that is a fantastic deal. Then in June 2020, they moved to AIM. In May 2020, they do a share placing for 16 million and also sign a mandate with Tribeca Resources for an acquisition debt facility of $10 million. And you can see from that point, there's much more liquidity in the share price. Then there's a gold mining royalty acquired in July 2020, a package of 4 further gold royalties in August. So, I mean, they're busy, they're picking things up. The question is, you know, these are quite small and they may have been substantial for a company with a market cap of 20 million, but now the market cap's 60 million, they are less important. And then in September, there's another gold project, 1.5% net smelter royalty, then 3 royalties over the Pukaka copper project in Peru. And then the big one, in March this year, so only 3 weeks ago, a big transformative lithium royalty over the Thakur Pass in Nevada. And so they had to raise 20 million sterling with a share placing at 34p to fund that. But that again is in the secondary market. Okay, so overview. Now they are saying that there is a gap in the market, that nobody is targeting small to mid-size mining projects, and also not just gold. There's a lot of mining royalty companies target gold, and they're aiming to be a diversified mining royalty company. They are showing that mining royalty companies have had absolutely extraordinary performance. But as we discussed earlier, I mean, the thing about Franco-Nevada, it signed these deals early on, and then when the mines come online, it signed these great deals, and the economics, obviously, Franco-Nevada have been extraordinary. But I wonder whether going forwards, the deals are going to be anywhere near as lucrative as they were 10 or 15 years ago. And we will go through all their deals. Okay, so Trident is aiming to target small to mid-sized firms. And it's also, this is the mining royalty sector by market cap. And it's almost exclusively focused on gold, essentially. Whereas the mining sector as a whole is only about 27% gold and precious metals. So it's aiming to be much more diversified. And this is the sort of corporate nonsense you get in a presentation. This is their value creation circle. If anyone can decipher this and make it intelligible, then please let us know. Now, the other thing they're saying is as the company grows, so its earnings multiple, so the price over NAV multiple will rise. So, you know, if you get in now, then as it grows, you will get an uplift as the market values it more highly. However, there is you are confusing several things in this chart, in that these companies have grown because the ones that are in existence now, they've grown because they signed deals years ago, which were very good. And, you know, you're conflating the size with the revenue stream, which may be misleading. So here you're Trident are essentially saying they are aiming for critical mass, and as they grow, their share price will be analogous to all these other successful mining royalty companies. Now, the one thing that is absolutely true, and is something that we really like, is that Trident have very low admin costs. And as their assets grow, then they do bigger deals, but they don't necessarily need to add many more admin staff. So their admin costs are very low. 1.2 million for a company with a market cap of 60 million. Now, if you remember when we covered Metal Tiger, they had a market cap of just over 20 million and costs of 2.7 million. So Trident is much more efficient in terms of administration costs. Okay, so let's go through their projects. And this is an overview, and it shows actually their largest, and you would hope because it's cost them the most money, is Thakur Pass Lithium. And when Thakur Pass comes online, that will produce the vast majority of their earnings. There's iron from Kulianobing, there's copper from Mimbula and Pukaka, and then there's gold. But as we go through this, you'll see a lot of the gold projects are really very speculative. And this is geographically where they are, and you can see most of their projects are actually in Australia, but the biggest one is in Nevada. It's the Thakur Pass Lithium mine, and they also have this copper project. So a copper project in Peru and one in Zambia. Okay, so going through their projects, well, the first deal they signed, and actually a really good deal, was this 1.5% FOB GRR on the Kulianobing iron ore project in Australia. He's aiming to produce 11 million tons per annum as of February 2020. So it's a big project, and it was sold by this company, which is a mining exploration company. And if you look on their website, they basically outline the reasons for selling it. This deal was done at the lows in commodity prices in March 2020, and they needed money, and they didn't think that the mining royalty really sat with their business objectives. So they sold it off. And really, this is an extraordinary deal. You know, if you comes down to the fact that in Q2 2020, they got a royalty payment of 500 grand, 67% higher than Q1 on higher iron ore prices and increased production. And as long as Kulia keeps on producing at least that levels, and they're ramping up, the oil price, iron ore price is up from there. So based on Q2 2020, they're producing annualized royalties of 2 million, and they purchased it for 3.9. And actually, I think given the mine is continuing to ramp up and iron ore prices have risen since there, you could easily see them getting more than that going forward. So this has been an absolutely extraordinary deal. The operator Mineral Resources won Hard Rock Mine of the Year for Kulia last year. So who knew that they had mine awards like that? Okay, so the next deal they signed was for the Mimbula copper mine in Zambia, and this is the only one where they've signed it directly with the mine. Okay, so Moxico Resources have a website, but they're a private company. And nowhere do they say what their annual production is going to be. They do give resource estimates, but they don't say what their production is going to be. My problem is this doesn't really look like a mining royalty deal. They paid 5 million upfront for 1.5% GRR on the Mimbula copper mine, but Moxico will repay the 5 million within 3 years. And once the 5 million has been repaid, the GRR falls to 0.3. So actually their royalty is 0.3%, and they've loaned them the money for 3 years. You know, so this isn't great. This is not a 1.5%, royalty, which is the headline deal. It's actually a loan of the money and 1.5% until the money's paid back, then 0.3%. And then after 575,000 tons of copper have been produced, the royalty rate falls to 0.2%. And we don't really have any idea of what the nameplate production of the mine is going to be. But based on a mine life of 20 years, something like 650K, rough estimate. And that was meaningful when the company had a market cap of 10 million. When the market cap is now 60 million, much less meaningful. And next one is Spring Hill Gold Project, which is a development asset. So, that is one of their more advanced projects. And the royalty rate is 13.3 Australian dollars per ounce above $1,500 an ounce. So that's where we are. So that is about $8 or $9 an ounce. Sorry, 750 sterling. But sorry, if the gold price is above Australian dollars 1,500, so $1,100, $1,150 US. So hopefully that will remain the royalty. And they're paying it in stages. So they paid 400,000 in cash, 400,000 Australian dollars in cash, and then the first gold is produced, they owe another 300,000 Australian dollars, and then further 300,000 when 50,000 ounces of gold have been produced. So this is de-risked. They've actually only coughed up 400,000 Australian dollars up front. We don't have any production numbers, so we don't know how much they're going to get per annum. But if you look at the ounces in place at £7.50 an ounce, you get to a maximum total of 2.5 million, which is a great deal given they're paid Australian dollars 1 million, so 550 grand for that. But again, you know, for a company with 60 million market cap, you need to sign quite a lot of these deals, because that is over what, 20 years? Not huge. Okay, then the next deal was 4 gold royalties in the Pilbara and Yilgarn regions of Western Australia. And again, this was bought in the secondary market. The purchase cost was 800k. I mean, these are small deals. So of those, only the Warrawoona project is in the development stage, and that looks really good, actually. But the others are in the exploration stage, and Mosquito Creek is, the developer is private, there's no website, and there's just no details. And in the case of Bullfinch, then the NSR can be repurchased for 950k. And if it's a successful project, that will go, you know. So, you know, based on success, maximum they will get is 950k. Okay, so let's go through these. Well, the most advanced one is Warrawoona, which is construction is due to start in Q1. So now they are aiming to produce 90,000 ounces per annum, which is great, because if we add that up, then that produces 1.7 million pounds per annum in a 1.5% net smelter royalty at $1,700 an ounce. That's great. And if they bought that for 800,000, I mean, it's one of those deals which looks slightly too good to be true. I mean, that really does justify, you know, purchasing the whole of these 4 assets, the other 3 of which are really very marginal. Okay, Talga is in the exploration phase. Now, this looks great. This is Talk Metals. Now, Talk Metals are not listed, and they have this project, Bullfinch. And we're going to go through this because this is interesting, but bear in mind that they can, Talk Metals can buy back the NSR for, what was it, 950 grand sterling. So that's not really very meaningful for Trident, but essentially they've got this exploration project called the Bullfinch, of which the Copperhead mine produced between 1910 and 1997 and produced 1 million ounces of gold. But contained within their mining area, they have these other old gold mines which produced small amounts from artisanal mining at quite extraordinary gold grades. So the Withers Fine prospect produced 1,700 ounces at 36 grams a ton, which is extraordinary. And Reynolds Find were produced at 12 grams a ton, Rutherford's Find at 20 grams a ton. So this looks a great project. Unfortunately for Trident Royalties, I don't think they're going to benefit much from it, even if it comes off. But it's something to watch if Talk Metals were ever to list, because this looks good. Okay, the next one is the Lake Rebecca Gold Project. And they have acquired, again from a third party, a 1.5% royalty over the whole area, whole project, for 8 million Australian, which is about 4.4 million sterling, of which the majority is in cash, but then there's Australian dollars 1 million in Trident Royalty shares at 29p. The project is well funded. They're aiming to advance this quite quickly. So this could be a big project, which looks good, and they've monitored a big resource. So you're talking about indicated resource of 550,000 ounces of gold with a further inferred of 225,000. And that resource is limited by the depth of the drills they've done. And you can see on this chart that outside the area that they have modeled, you're still getting very high gold grade. So the resource could be even bigger based on the resource, not production, on the resource, then, and including, so inferred plus indicated, your 1.5% royalty is worth a lot of money, 20 million, but 19 million. But that is, we have no idea of production numbers and also of when actually the mine will come into operation. Okay, next up is Pukaka Copper Project in Peru. This is a deal they bought off Orion for 8 million in Trident shares at 32p, and it's being developed by Nexa Resources. Now, this is a big resource, but the copper grade is really poor. The copper grade is like 0.4%. That looks pretty marginal to me, actually. And the net smelter royalty is 2%. But the reason Orion had bought it is that it's currently in pre-feasibility and it's on hold. So Nexa, during the COVID crisis, they decided to, they were capital constrained and they have decided to put Pukaka on the back burner for now. So, worries about buying third-party deals where there's a selection bias. I mean, there's a reason Orion have sold this on. Okay, so then we get to the big one, which is Thakur Pass Lithium project. Now, they've only bought 60% of the Thakur Pass Lithium project gross revenue royalty from Orion. 28 million, 26 million in cash and 2 million in Trident shares at 34p. And its current status is it's awaiting permits. First production is expected in 2024. Okay, so this is a big project with proven reserves of 2.4 million tons of lithium carbonate and a further probable reserves of 780,000 tons. And they're aiming to produce 60,000 tons per annum with an estimated mine life of 60 years. So this is a project where Trident will get royalties for many years. But in the early years, it will take some time for Thakur Pass to get up to final production. You can see bottom right here, the repayment schedule. And you'll see that there is a big repayment in 2024. And then royalty payments going forward and increasing as the mine ramps up. But again, the headline gross revenue royalty is misleading. Although the headline GRR is 8%, once Thakur Pass have repaid 22 million in royalty, it would fall to 4%. However, they also have the option at any time of reducing the GRR to 1.75% by paying 22 million. So it is assumed that they will do so immediately in the first year. At that point, Trident's 60% interest equates to an uncapped 1.05% GRR. So another way to look at this is they've loaned them the money until the mine comes in operation at 2024, at which point they will get the majority of it back, but will retain a 1% gross revenue royalty. So, the headline numbers of 8% GRR, 4% are misleading. This is a 1% for Trident. Tamisis are estimating that during phase 1, Trident will receive 1.6 million per annum, and then during phase 2, they'll get 4.7 million. and the net cost will have been 10.8 million. So, these are very good numbers. Eventually, when the mine is fully in production in 2029, these numbers look very good, but that's quite a long way off. You're talking about 8 years from now when the mine is in phase 2 production of 60,000 tons per annum. And obviously, the lithium carbonate prices are doing quite well recently. This is where it is. So it is in Nevada. So there should be no problems with infrastructure, and it's currently in the permitting phase. So one of those advanced lithium projects in America. And if we believe that the EV revolution is going to accelerate and that lithium batteries will remain the battery of choice for the electric vehicle revolution, then this could be very good for Trident. But it's very much a case of jam in a few years' time. So we then look at summary. Kulia knobbing, uncapped 1.5%. I mean, that looks great. That looks a great deal. The Mimbula actually is 0.3%. Spring Hill is in development. And then you have a royalty of, $8 an ounce. We don't know how much they're going to be producing per annum. Warrawoona, that looks great, and that is in development. Talga, Bullfinch, and Mosquito Creek are all in the exploration phase and very, very speculative. Spring Hill is in development. That looks good. Pukaka is in pre-feasibility. They're paid quite a lot for that. I mean, the copper grades are really, frankly, quite marginal. And as we've seen, it's currently on the back burner. Thakur Pass looks good, but really you're talking about 2024 before you get any royalties, and 2029 before serious royalties start coming through. And these are the financials, which are frankly not very meaningful. But on a market cap of 60 million, the administrative expenses are really very low. And actually, if you break them down further, you'll see the employee benefits are really quite low. And a lot of the admin costs are due to due diligence fees and other professional fees. So you did have offsetting that were foreign exchange gains. But, if you just look at employee benefit expenses, market cap of 60 million, you're talking about 500 sterling per annum. That's good. We like that. Efficiently run. So turning to the positives, low admin costs, very active management, signed 7 deals, mainly since last year, actually, the vast majority of them coming within the last year. And it's a chance to buy in at an early stage growing mining royalty company, which, if it follows the pathway of other mining royalty companies, could do very well in the coming years. And the Thakur Pass royalty project gives them exposure to the rising lithium price and to battery elements, and will be a big chunk of their earnings going forward. And the Kulia knobbing iron ore mine looks great. And hopefully, as they grow, they'll get better access to deals, because right now, a lot of their deals are coming from third parties, like the negatives. Well, obviously, it's difficult to value because a lot of these projects are at an early stage. There are all the usual caveats associated with early stage mining projects. In terms of the number of projects, a lot of the portfolio is in gold. Their projects are at an exploratory stage or an early stage. So, and in the case of Bullfinch, for example, then the maximum they can get is capped because there are options to repurchase. But my biggest concerns really are about the fact that this whole industry has become much more competitive. The deals they're signing, and if you think about the Mimbula mine, actually it looks like a 1.5% net smelter royalty, but it's not. It's actually loaning them $5 million and for an ongoing smelter royalty of 0.3%. So I think that actually the whole industry has become much more competitive. And more than that, Trident are actually picking up most of their deals from third parties. And particularly in the case of Orion and Pukaka, you wonder, there's a reason that Orion got rid of that mine, frankly. So it's picking up the leavings of other larger smelter mining royalty companies. So I'm concerned that actually by looking at the historic performance of other mining royalty companies, we are anchoring on the wrong metric, that that performance will not be repeated going forward because a lot of companies have entered the market. So in summary, tricky. Honestly, I just worry that these deals are not going to be as lucrative as they were in the past. That said, you know, Thakur Pass looks good. It signed some good deals with Kulianobbing in particular, and Warrawoona also looks good. So I have a bit of this and I will be sticking with it because I like mining royalty companies, and once they start kicking off cash, then the costs are very low and all those earnings should be paid out as dividends. So this is a holding for the long term, but not necessarily a large one. Richard, your thoughts?
Great. Thank you very much for the detailed presentation, Keith. Very interesting. I agree with you. I think mining royalty companies, Franco-Nevada, I think was the first, certainly the first one in the gold mining sector. And I think their first deals were incredibly lucrative perpetuities. And more and more people have realized that it was a lucrative way of investing in mining, and more people have entered into that market. And clearly then the returns have dropped, haven't they? And the available deals are not as lucrative as they used to be. The difficulty with this particular company, I think, is that they seem to have quite a hit and miss relationship with their deals. Some of them look like they're probably very good, and some of them look like they're probably not very good at all. And so there's a sort of lack of consistency there. And the question mark is not so much that are their earnings going to cover their market cap, because their earnings probably will get up with the current portfolio, get up to 6 or 8 million, the market cap 60 million. Mm-hmm. You know, but will they actually be able to grow very much on top of that, given what we're seeing in the royalty sector generally? Now that applies to all royalty companies, but if you've already got your cash flow and you're kicking off a nice dividend, then it's a slightly different kettle of fish. Also, if they're small, does that limit their accessibility, their access to larger, more lucrative deals? I don't know. So I agree with your overall summary. Tricky to know. I suspect that if you do a bit of research into junior miners, listed junior miners, you might find you can do better than you can out of the royalty company. But you have to make sure you pick the right junior miners.
Yes.
Clearly, there's a risk there.
In terms of short-term upside and multi-bagging, I think that's absolutely true, Richard. And I think you're buying the royalty companies for long-term dividend potential. Yeah. And when Thakur Pass comes online, and if it does what it says it's going to do, and the company has very low administrative costs, then you're looking at, a decent dividend yield. You could well see this kicking off, 7 or 8% yield.
Yeah, I agree, Keith. And as you know, I've got shares in Ely Gold, which is a mining royalty company, and I'm not proposing to sell them. Yeah. But I just feel that maybe these companies are having their last hurrah. I noticed also you said private equity is entering, and that's obvious because there are significant returns to have been had.
Yeah.
So maybe the time to invest in this this sector is coming to an end.
Yes. No, I think that's, I agree. I think private equity, we notice you're buying these off Orion, the secondary market. So
Yeah.
I worry that private equity have got there first in a lot of these cases, and being a sub-scale mining royalty company, you are just resorting to having to pick up the leavings of other larger companies.
Yeah. Well, thank you very much, Keith. It was a very interesting presentation, and people will make up their own minds.
Absolutely. And if you have any feedback, please can you add it, leave a comment. And we obviously really appreciate new information. And as people provide information, we update the description. So if you're interested in Trident, check back because we will be posting new information in the description. In the meantime, thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.